here's what nobody in finance actually asks you. Not which investment makes more money, but which life are you willing to live? Because here's what 20 years of real-world data tells us. Both paths, real estate and the stock market, can get you to roughly the same net worth. The difference isn't the destination. The difference is what the journey costs you, in hours, in stress, in the kind of Sunday nights you have. Today on Whymeric, we're not going to tell you which one wins. We're going to show you 3 layers of reality and then let you decide based on who you actually are, because that is the only math that matters. Let's build this comparison the right way. No stacking the deck, no hitting advantages, apples to apples. 2 people, both 32 years old, both earning $55,000 a year, both starting with $50,000 saved. And here's where it gets fair. Both of them set aside $300 every single month, no exceptions. Jake uses his $50,000 as a 20% down payment on a $250,000 rental property, 3 bedrooms, 7% mortgage rate. His tenant pays $1,800 a month, and his $300 monthly, he reinvests it, either into the property reserves or into a side index fund. Marcus puts his full $50,000 into a total market index fund. His $300 a month goes in automatically every month for 20 years. Same income, same starting capital, same monthly commitment. Now we're actually comparing the same human being, just making 2 different choices. And the results are far more interesting than any single headline will ever tell you. Layer 1. The perfect world, the spreadsheet version. In a perfect world, Jake's property appreciates at the national historical average, roughly 4 to 5% per year. His tenant never misses a payment. Repairs stay predictable. He refinances once when rates dip, pulling out equity to buy a second property by year 8. By year 20, Jake's portfolio of 2 properties is worth somewhere between $800,000 and $1 million in combined value. His leveraged equity position, what he actually owns, sits around $500,000 to $600,000. In a perfect world, Marcus's index fund compounds at the historical average of around 10% annually, with dividends reinvested. By year 20, his portfolio has grown to $550,000 to $650,000. In the perfect world, real estate wins. Leverage is a multiplier that index funds simply cannot match, 1-to-1. But here's the problem with perfect worlds. Nobody lives in one. Layer 2, the real world, where friction lives. In the real world, Jake's first tenant leaves after 14 months. That's $2,700 gone. Then a water heater fails, $1,200. Then by year 6, the roof needs work, $8,000. Taxes, insurance, a management headache he didn't expect when he took a week-long work trip. His actual net cash flow in year 1 through 5, somewhere between $2,000 and $4,000 total, not per year, total. Meanwhile, in the real world, Marcus's portfolio drops 32% in a market correction. On paper, he loses $60,000 in 8 months, and that number is terrifying to look at. In the real world, Jake's equity advantage shrinks when you strip out time and unexpected costs. In the real world, Marcus's compound returns stumble through 1 or 2 brutal years. In the real world, both paths have serious friction. The question is which friction is friction you can handle. Layer 3. This is the layer that actually determines your outcome. The stock market crashed more than 30% in 2008 and again in 2020. Research consistently shows that a significant portion of retail investors sold near the bottom. They didn't lose money because the market was broken. They lost money because their own psychology was louder than their strategy. That's not stupidity. That is a deeply human response to watching something you build dissolve on a screen. And real estate? The behavioral trap is different but equally powerful. the lazy landlord who ignores maintenance until a small problem becomes a $15,000 capital expenditure, the investor who buys in a market where rent is only 0.5% of the purchase price and wonders why the numbers never work. Most real estate failures aren't market failures. Most stock market failures aren't market failures. They are behavior failures. This is the layer that no spreadsheet shows you, and it is the only layer that is entirely within your control. Now, let's give real estate its full credit, because a shallow comparison does nobody any good. Leverage. Jake used $50,000 to control a $250,000 asset, 5-to-1. When that property appreciated just 3%, his actual return on invested cash was 15%. Marcus cannot do that in a standard brokerage account. Rent increases. Over 20 years, rents historically climb alongside inflation. The mortgage payment stays fixed. That spread gets more powerful every single year. Tax structure. Depreciation lets Jake deduct a theoretical loss on paper while the property gains real value. A 1031 exchange lets him roll profits from one property into the next without triggering capital gains taxes indefinitely. And equity extraction, a cash-out refinance, or a home equity line of credit can fund his next investment using the appreciation he already earned. None of these tools exist for index fund investors. That is a genuine structural advantage. The question is whether you have the temperament and the time to use them. So let's stop pretending there's one right answer. If you are someone who loses sleep watching a portfolio drop 40% on a screen, who has no interest in managing contractors or reading lease agreements, who values time and simplicity above all else, index funds are not the lazy choice. They are the psychologically correct choice for who you are. If you are someone who wants control, who understands that leverage is a tool, not a gamble, who is willing to treat real estate like a business and not a passive investment, real estate done right with real numbers, real reserves, and real market discipline can outperform everything. And if you're the person sitting here saying, "I want both," you're probably the one who ends up wealthiest, because the most powerful portfolio in 2026 America isn't choosing sides. Stocks provide your liquid, passive long game. Real estate, when the rent-to-price ratio actually works, gives you the leverage and tax shelter that compounds wealth in a completely different dimension. Here is the real math that this video has been building toward. Jake done right ends up between $500,000 and $1 million, depending on whether he scales intelligently or stays at one property. Marcus done right ends up between $550,000 and $650,000 if he never panic sells and keeps contributing. Jake done wrong, over-leveraged, under-reserved, bad market can lose everything. Marcus done wrong, panic sold at the bottom, paused contributions during fear, ends up with $200,000 less than he should have. The investment doesn't make you wealthy. The behavior behind the investment makes you wealthy. And behavior is the one variable in this entire equation that no market, no crash, and no interest rate can control for you. The question was never which one wins. The question was always, which version of yourself are you building toward? If you want freedom, own your index fund and protect it with patience. If you want leverage, own your real estate and protect it with discipline. If you want both, start with one, do it right, then build the other. Don't pick an investment, pick a life. That's Whymeric. We'll see you in the next one.